So when we decide the working capital to either increase or decrease, we should compare the current year working capital with the previous working capital. I gave an example. 20,000 is the last. Current year is 50,000. Now the working capital is increased. So what is happening here? The funds are going up. So all these steps has to be incorporated in the final statement of funds flow. That means cash is moving out. In case if the working capital is reverse, last year is 50,000, current year 20,000, your working capital has decreased. That means you are spending less amount than the last year. You are saving the funds. It is a source. It will be shown if the working capital decreases, it will be shown in the inflow or sources. If the working capital increases, it will be shown on the outflow or it will be shown on application side. So this is the first step to determine the changes in the working capital. The second one is operating it. Cash from operating operations, like that funds from operation. What is meant by operation? I think you know what is meant by operation is nothing but just operating your activities like selling and buying of goods and services that determines your EBIT, earning before interest tax, or profit before interest tax, or operating income. You will be provided your company's profit and loss account. You should determine whether you are getting a funds from operation or funds lost in operation. In order to find out the funds from operation or funds lost in operation, you have to prepare the funds from operation. This is the second step. You should take the net profit of your business, and for this, you should add any expenditure which is not related to the business, that is non-business expenses or non-operating expenses. But your accountant has already debited in your profit and loss account. What happened when your accountant debits the expenditure which is not related to business? Automatically your profit says lessened down because of recording of all non-operating expenses. So you have to add back all the non-operating expenses to your net profit or non-business expenses to your net profit in order to decide or determine the funds from operation or funds lost. So first let's take the net profit. For this, you have to add the non-fund and the non-operating expenses, depreciation, non-fund or a non-cash. Transfer to general reserve. Where do you transfer to general? Where do you create the general reserves? The reserves are created out of your profits. That is also your profit. If you want to know the true profit, you have to add back to your net profit. Goodwill write-off, patent write-off, preliminary expenses write-off. All these fictitious assets written off is added back to your net profit. Loss on sale of fixed assets, I already explained you in the cost concept. Always the fixed assets should be shown at historical cost, not at realized value, NRV, net realized value. Why? Because you are not intended to shut down your business. When your business is a going concern concept, you should always show your fixed assets at cost price, not at NRV. When the lifetime of the non-current asset has been expired, then you will dispose that asset. You may get the profit or loss. When you get a loss on sale of fixed assets, that is treated as capital loss, not a revenue loss. In case if your account debits the loss on fixed assets in profit and loss account debit side, that means your profit comes down because of debiting, means it is implied that it has been deducted from the profit. It is added back to the net profit. Or any provisions. All provisions are provided out of your profit. If you provide any amount towards for taxation, payment of tax in the ensuing future, so that is also created from the current year profit. So that is also added back to your net profit to know your real profit. Current year proposed dividends. So non-fund and non-operating expenses, which has already been debited in your profit and loss account, because of that, your profits has been lessened. To know the true profit, the candid profit, you should add back these non-fund and non-operating expenses to your net profit. Out of these, you have to deduct non-fund and non-operating incomes. What are the non-fund and non-operating incomes? Appreciation on revaluation of assets. When your assets are revalued, assets, sometimes it may be revalued. It can be shown at market value when there is a dire need. Otherwise, yeah, fixed assets always be shown at book value or at carrying cost value, not at an RV or not at a market value or whatever it may be, price rental value, whatever you call it. You cannot show it like that. Why? You are a going concern person. So when there is an appreciation, that is to be deducted. Why? Because when you credited your appreciation on assets on the P&L account trade side, your profits has gone up, raised because of crediting these items. Tax refund. If you pay more tax to the government, advance tax, and the government has refunded that money, so automatically it is also known as non-operating income. It is not related to business. Income from house property. That is the other source, income from house property. That is not a business. It should not be credited to your profit and loss. That should be added back to your net profit. Profit on sale of fixed assets. I told you that fixed assets are not meant for sale. When you dispose the fixed assets, you may get a profit or a loss. That is a capital loss or a capital profit. That is also should not be credited in profit and loss account. So it is to be deducted from your net profit. Then you'll get, if you get a positive value, it is a funds from operation. If you get a negative value, that is known as funds lost in operation. These funds from operation or funds lost to operation, it should be incorporated ultimately in the funds flow statement. If it is a funds from operation, you are getting funds, source. It will be shown on the sources side, inflow. Where got? From which activities you got all these sources? If you lost the funds, if you deprived the funds in your business through your operating activities, your funds are moving out. Where do you apply? Where do you spend your funds? Where has gone? This all will be shown on the outflow side. This is the second step. Coming to the third step. When you are provided non-current assets, not only non-current assets, other items like provision for tax or proposed dividend, if you are given these items, both in balance sheet as well as in your additional information, you have to prepare a separate account. If it is a land, you are given last year land and the value and current year land value in the balance sheet, and in the adjustment, you are given a depreciation on land. There will be no depreciation on land. Let us take, for example, machinery. Depreciation on machinery. You have to prepare the machinery account. The difference in this machinery account, it may become as a sale or purchase. If it is on the credit side, the difference, it is treated as sale. If it is on the debit side, it is treated as purchase of fixed assets or non-current assets. In the same way, provision for tax. If you are given both in balance sheet and adjustment, the item given in the balance sheet, the provision for tax being as a liability, it shows a credit balance. Opening balance is credited and closing balance is debited. In the adjustment, if you are provided a tax paid, tax account deduct to cash, it will be shown on the provision for tax account debit side because the cash is moving out. The difference is treated as current year provision for tax. If provision is given, the difference is treated as tax paid. If tax paid is given, the difference is treated as provision. So this provision for tax is prepared, this account, to find out whether you paid the tax or whether you currently created the provision for tax. In the same way, proposed dividend also. To know whether you paid the dividend or whether you are going to propose the dividend. So basing upon the proposed dividend account, after preparing, you can cognize whether you paid the dividend current year or whether you have proposed. Ultimately, the differences in these accounts will be incorporated in funds flow statement. If it is a sale, you are getting funds. That is source. It will be shown on the sources. If it is a purchase, your funds are moving out. When the funds are budging out, you have to show this purchase of assets on the outflow side of your funds flow statement. This is the third step. The first step is changes in working capital, whether to know whether working capital is increased or whether working capital is decreased. The second one is funds from operation, to know whether funds are coming in or funds lost in operation. The third one is when you are given in balance sheet and adjustment, you have to prepare the concerned accounts and the balances to be ascertained, and that balances will be shown the ultimate statement, that is funds flow statement. Now let's come to finally the funds flow statement. So already in the earlier I told you the funds flow statement is also known as sources of funds and application of funds, or where got and where gone statement. So this is a statement, not an account. All sources will be shown on the left side and all payments will be shown on the right side. Let us compare your 2 consecutive years financial statements. Equity share capital, for example. Your last year capital is 1 lakh and current year capital is 2 lakhs. Your capital is raised than the last year by 1 lakh rupees. When you are raising the capital, when you are amassing or accumulating the capital from the public, then the last year, you are getting funds that will be shown on the inflow sources side. If the same item is reversed, that means the last year capital is 2 lakhs and current year capital is 1 lakh, your capital has been reduced. That means you redeem, you reback the capital to your shareholders. That happens in case of buyback of shares. We all know that until 1998 in India, the buyback of shares is not there. After Atal Bihari Vajpayee, the Honorable Prime Minister, when he became a Prime Minister, he first introduced the buyback of shares. So redemption of share capital, it will be shown on the applications. Next, come to the debentures. Same, debentures also will have to give the same treatment. You all know that debenture is not a capital, owner's capital. This is a long-term loan which is borrowed by the company from the people. Debenture is an acknowledgement of debt borrowed for a specific period at a fixed rate of interest. After the expiry of the stipulation period, you have to redeem these debentures. The company may raise sometimes the funds without issuing the share capital by issuing the debentures. Share is different from debenture. Share is the real owner of the company and the debenture holder is not a owner, just is a lender of the company. Shareholder will get a dividend. He enjoys the profits. His dividend will change basing upon the profit. If the company gets a good profit, the company can pay a good dividend to the shareholders. They can enjoy and the share value also will be augmented in the market. But whereas the debenture holders, they are not at all empowered and entitled to enjoy the profit. They will get only, they are confined to only a fixed rate of interest till their amount is redeemed. Shareholders can contest in the director selections. Debenture holders cannot contest in the director selections. Shareholders have the voting power. Debenture holders won't have the voting power. Shares can be issued only at a premium or at par value, cannot be issued at discount. But debentures can be issued at par value, at premium, or at discount also. Shares cannot be converted into debenture, but debenture can be converted into shares. Shareholder have the voting right. Debenture holders have no voting right. So this is the distinction between share and debenture. So if the debenture is raised, funds are coming in. You are borrowing the loans, debited. Sorry, left side sources. If the funds are moving out, it will be shown on the application side. In the same way, long-term loans. If you borrowed any loans from the bankers or any financial institutions, that is also you have to give the same treatment like debentures. Every item of the financial statement, it appears only one time. But every item of the adjustment, it should appear 2 times. One time of the above 3 steps, either any one of the above 3 steps, and another one is at funds flow statement. Next, changes in working capital. If it is increases, it will be shown on application side. Already I explained. If it decreases, it is shown in the sources side. Funds lost or funds from operation. Second step. That is also should be incorporated here. Funds from operation is shown on the sources side. Funds lost in operation. When you deprive the funds is going out, budging out, it will be shown on the outflow side. Applications. And third step, I told you that you have to prepare an account when you are provided the information both in balance sheet as well as in adjustment. You might get some difference in that account. That may be sale of fixed asset or purchase of fixed. All purchases will be shown on the outflow application side, and all sales you are getting funds into your organization, it is shown on the sources side. Any receipts will be shown on sources side, and any payments will be shown on outflow side. Tax refund sources, tax paid applications, dividend paid application. So drawings, if the proprietor uses any amount for his personal use for the domestic purpose. Again, I explained to you in the business entity concept regarding the drawings. Salary paid to your employees is a business. Salary to pay to your maid servant is not a business. It is a personal. It is a domestic purpose. How do you enter your personal expense in business P&L account? You're not supposed to enter your whole domestic purpose expenses, sales, son's education, and daughter's marriage expenses, and paid to beggar, all this expenditure, that expenditure. You're all domestic persons. Personal expense will not be entered in the funds flow statements or either in the company's profit and loss. So ultimately, when you close your funds flow statement, it should be balanced. Sometimes it may not be balanced. When you are not provided the current assets and current liabilities, the difference is treated as either decrease in current assets, working capital, or increase in working capital. I think you understood, friends. This is related to pertaining to the funds flow statement. So in the next video, we can discuss what is the distinction between funds flow and cash flow. Okay. Thank you, one and all.